If investing feels confusing, that's probably because the internet turned it into entertainment. One guy says this stock is about to 10x overnight. Another says the market is collapsing. Meanwhile, some random dude claims he turned $800 into $80,000 trading options from a downtown Toronto condo beside a rented Lamborghini. Now suddenly investing feels like you need free monitors, advanced charts, and a mild caffeine addiction just to retire someday. Meanwhile, some boring guy named Dave has quietly been buying one ETF every month for 15 years and accidentally owns thousands of companies around the world. And somehow, Dave is probably winning. That's the part beginners rarely hear. Most professional fund managers struggle to consistently outperform simple index funds over long periods anyway, which honestly becomes kind of funny when you realize people are paying massive mutual fund fees to underperform the market professionally. John Bogle built an entire philosophy around this idea. Instead of trying to outsmart the market, Bogle believed most people were better off simply owning the market itself. Simple, boring, effective, and somehow, that boring strategy beat most people trying way harder, which is probably the most annoying part of investing, because humans naturally assume the more complicated plan must be smarter. But before we go further, we should probably answer one question. What even is an ETF? An ETF is basically a basket of investments. Instead of putting all your money into one company, you own tiny pieces of hundreds, sometimes thousands, all at once. Think about it like this. Instead of betting your future on one Tim Hortons location, you own part of the entire food court. That's diversification. And diversification matters because markets can humble people very quickly. Bull markets hide a lot of bad decisions. Everything feels genius-level smart. When stocks only go up, real risk tolerance shows up. When your portfolio suddenly drops 30%, and now you're checking Wealthsimple before bed, like it's playoff overtime, you are thinking, this is long-term investing. I'm staying calm. Okay, maybe a little panic selling. That's usually when investors realize their emotions weren't nearly as diversified as their portfolio. Then there's fees, the financial equivalent of a slow leak in your tire. Most beginners ignore them because percentages sound tiny. But over decades, small percentages become serious money. A 0.2% management fee on $10,000? Roughly $20 a year. Not terrible. A 2% fee? Now you're paying closer to $200 every single year for the same amount invested. Stretch that across decades, larger balances, and compound growth. And suddenly you've donated a shocking amount of money to somebody in a downtown office tower, posting motivational LinkedIn content. Canada historically became famous for high mutual fund fees, which honestly feels impressive in the worst possible way. Still, fees aren't the biggest reason people fail investing. Emotions are. People panic. People chase hype. People buy high, get nervous, then sell low. That cycle destroys more portfolios than bad ETFs ever will. Social media only pours gasoline on this. Every year, there's a new obsession. Crypto, artificial intelligence, cannabis stocks, options trading, whatever's exploding online that month, suddenly turns everybody into a market genius. Your cousin starts giving stock tips at Thanksgiving dinner. The guy at the hockey rink suddenly has economic insights. Even your Uber driver somehow discovered a once-in-a-lifetime opportunity. That's usually the warning sign. When everybody feels brilliant, things tend to get dangerous. Then markets crash, and suddenly nobody wants to talk about investing anymore. Funny how that works. So let's talk about the ETFs Canadians keep buying. First, XEQT. XEQT became popular for one major reason. It removes decision fatigue. One ETF. Global diversification. Low fees. Done. US companies. Canadian companies. International markets. Emerging economies. Thousands of businesses. Inside one investment. Historically, globally diversified stock portfolios performed well over long periods. Not every year. Not without painful crashes. But over decades. Patience usually got rewarded. That simplicity is exactly why people love XEQT. Buy consistently. Go outside. Touch grass. Stop checking your portfolio every 11 minutes. But there's still a reality people forget. XEQT is 100% stocks. So during major downturns, this thing can fall hard. A lot of investors think they can handle volatility until their portfolio suddenly drops. The price of a used Honda Civic. Then long-term investing starts feeling extremely personal. Now eventually, almost every Canadian discovers VFV. At some point, people look at US stock returns, see companies like Apple, Microsoft, Amazon, and Nvidia, then start asking, wait, why am I investing anywhere else? And honestly, fair question. The American market has performed incredibly well for a long time. That's why Canadians love VFV. It tracks the S&P 500. So you're basically investing in America's corporate superstars. But there's a trade-off. VFV is less diversified than XEQT because it leans heavily into giant US companies, especially technology. Feels amazing during bull markets. Feels very different when tech stocks suddenly get humbled, and everyone remembers why diversification existed in the first place. Now on the opposite side, you have ETFs like cash and CBIL. These are not designed to be exciting. They exist for stability, emergency funds, short-term savings, house down payments, money you might genuinely need soon. And honestly, that matters way more than people realize. Because life has a funny habit of demanding money at exactly the worst possible moment. Markets usually recover eventually. Your landlord does not care that the S&P 500 is probably bouncing back next quarter. That's why safer investments exist, not to maximize excitement, but to protect stability. Then there's TEC, the ETF that makes people feel like they understand the future of civilization. During tech bull markets, artificial intelligence, semiconductors, big tech companies. When tech stocks are flying, holding TEC feels incredible. You start watching Nvidia earnings calls, like it's the Stanley Cup Finals. But higher growth usually comes with higher volatility. TEC can move aggressively, both upward and downward. Think sports car. Amazing on smooth roads. Completely different experience during a February snowstorm in Canada. Finally, dividend ETFs. VDY. XEI. Dividend investors always sound weirdly calm. Probably because getting paid regular cash flow does something psychological to people. You feel productive, financially responsible, weirdly mature, like Warren Buffett eating Costco hot dogs, while everybody else panic refreshes their brokerage account. But even dividend ETFs have trade-offs. Many Canadian dividend funds lean heavily into banks, utilities, and telecom companies, which means investors can accidentally become far less diversified than they realize. And honestly, this is probably the biggest lesson in the entire video. The best ETF usually is not the one with the highest returns. It's the one you can emotionally survive holding. For decades, most people don't fail investing because they're unintelligent. They fail because emotions eventually take over. The boring investor consistently buying diversified ETFs for 20 years has historically beaten the investor constantly chasing hype. Boring investing wins. Not because it's exciting, because it's repeatable. And most wealth isn't built through brilliance. It's built through patience. So if you take one thing away from this video, let it be this. You do not need constant trading. You do not need stock predictions. You need diversification, consistency, patience, and enough emotional control to keep investing. When markets stop feeling fun,